Prices in crude appear to have moved higher than their fundamentals suggest. And Dan, I feel like a broken record here, but this is definitely a technical rally. Nothing's changed fundamentally.
You know, we're all, I say all. I mean, everybody who I have respect for inside the oil industry is saying that, you know, a lot of what we're looking at is, you know, not a fundamental-based rally, that it is going to be short-lived and in fact doesn't have a lot to support it. But, you know, 25 years on the trading floor tells me when we all agree, maybe it's time to go the other way. But I just can't. I mean, I'm in the boat with Paribas, Jeff Curry of Goldman Sachs. You have something from Barclays that says, you know, the rally is overdone. The IEA seems to think the rally is overdone. Chinese numbers, for example, you know, we've talked about this. A lot of people have pointed to demand increases from China, but, you know, we found out that all of that extra crude that's going into China is just going into stockpiles, you know, and they're going to have this huge glut of oil just like we do here in the United States.
But it feels like the demand increases. It's really phantom globally.
That's what it is. And, you know, a lot of this stuff, I mean, the increases that are coming are going elsewhere. They're not being used. A lot of the demand is starting to slacken off, both here in the United States and in Europe. And I just see, you know, over at least the next several months, until a lot more production comes offline, that, you know, we're just not going to see a major rally in prices. Of course, I didn't think we would get above 60.
Well, it feels as if it's impacting other asset classes as well. It's almost like a phantom rally around the world. But what about the fracklog unwind? What does that mean?
Right. You know, when we get towards these levels, you know, 62, we're looking at a $65 level. There's lots of shale players out there who've put wells before completion. So they've thrown a tarp over the wells and they've said, we'll come back to it another time when the money is right. At $65 on a lot of these wells, the money is right. So CapEx will start building again. You'll see some of the tarps come off of these rigs. More production will come online at some point, and you will see perhaps what we might call a double dip recession in oil, where we saw, you know, a dip to $40 and a secondary dip into the 45 range. And now when we're hovering closer to 65, give it a couple of weeks or a month or two, and some of these production numbers will start to creep back upwards, and maybe that will be the next slide that we'll see.
So what's the appropriate level? What makes sense here? 45, 50?
I've always said that, you know, from the start, that when prices were dropping and people were calling for $25 oil, we weren't going to see that. 40 was pretty much the outside limit. And when we started going up, I thought that $60 was the outside limit. So clearly I'm somewhere right in the ballpark. This, of course, ignores, you know, what happens when real production comes offline. But again, I don't expect that to happen for another 2 quarters.
Okay, thanks very much, Dan.
Right.
For TheStreet in New York, I'm Jill Malandrino.